So my name is Raj Shah. I'm a Senior Strategy Associate with the Options Institute and Cboe Europe, and I'm excited to be diving into unlocking index options trading with you guys today. So just for some background, Cboe Europe and specifically Cboe Europe Derivatives, CEDX, is a derivatives marketplace across Europe offering a wide variety of derivative products, so both equity index derivatives and options and equity derivatives on single stock names. At present, we have over 300 single stock derivatives available for trading across various countries in Europe. And then for the Options Institute, we're the education arm of the exchange, so educating investors day in and day out about the financial markets and the derivatives marketplace as well. We have a lot of different offerings. Most of these are free, so if you are interested, please feel free to come up to our booth. It's going to be M26, M27. Come up, I'm more than happy to discuss anything you'd like to know. And we have a QR code on the screen as well if you'd like to learn more about Cboe Europe derivatives. All right, so for today's session, I have two main goals. First, just diving a little bit deeper into what options are, its features, characteristics, and trying to understand, like, why do investors really use options? And then secondly, trying to think about if you were to trade an option, what would your profit and loss look like? How do you visualize that kind of a profit and loss scenario? And we're going to do that using some examples with payout diagrams. The ultimate goal here is to combine your knowledge of options with your understanding of payout diagrams to give you all the tools you need to learn and trade options. All right, so we'll start with the what. So what is exactly an option? Well, formally defined, it's a financial contract that gives the owner the right, but not the obligation, to buy or sell the underlying asset at a specific price within a specific time frame. So in the world of exchange-listed and traded derivatives, there are two main types. You may or may not have heard this. It's called calls and puts. So calls give the owner the right but not the obligation to buy the underlying asset, and puts give the owner the right but not the obligation to sell the underlying asset. Now, when you hear this definition for the first time, you might think to yourself, this sounds a lot like a futures contract or a forward contract. So what's the difference? Well, an option is just that. It's an option, it's a choice. So options offer you more flexibility in making your trading decisions. All right, so now that we have the what out of the way, let's think about why. Why do investors actually use options? Where investors can use options for any number of reasons. These are the 5 reasons that we have distilled through our conversations over the years with clients and individuals that trade options. First up is income generation. So options can actually be used to sell. You can actually sell options to generate income over time on a regular frequency and increase your capital over time. There's also capital protection. So options can be used essentially as insurance. A lot of investors and traders have existing market positions, and they're always looking for a way to protect themselves from a market downturn or an adverse market condition. Options can help you do that. You also have risk management or hedging. So this is about hedging specific variables of exposure. So if let's say you have a portfolio that is very sensitive to interest rates, and let's say the Bank of England starts raising interest rates again, you can use options to actually protect your portfolio from that rising interest rate environment. We've also got efficient exposure. So options are capital efficient tools. They have something of an embedded leverage component. So basically, to establish a position, you would require relatively lower capital to start out, and it can also define your losses if you're an owner of the option. And finally, managing cash flows. So a lot of individuals and institutions have cash flow commitments they need to meet over a set period of time, so a week, a month, a year. Options can help you manage both your incoming and outgoing cash flows. So these are just some reasons why investors really use options, integrate them in their portfolio, and help manage their risk. So now we know there are 2 types of options. You've got calls and you've got puts, and there are 2 things that you can do with either option. You can either buy them or you can sell them. So the permutation of all these leads to 4 possible actions. You can buy a call, you can buy a put, you can sell a call, and you can sell a put. But over time, as we've spoken to various clients and traders, it can get a little confusing in terms of exposure. What does this really mean? So let's look into it. First up, buying calls. So when you buy a call, you're buying the right to buy the underlying asset. Essentially, you have long exposure. On the other hand, when you buy a put, you're buying the rights to sell the underlying asset. Hence, you have short exposure. Now let's look at the flip side. So when you are selling calls, you're selling the right to buy the underlying asset. Essentially, you want the underlying price to go down below the price where you'd have to sell it. Hence, you have short exposure. And on the other hand, when you sell a put, you're selling the rights to sell the underlying asset, which means, guessed it, you want the underlying price to go up above the price where you'd have to buy it. Hence, you have long exposure. And once again, another nuance that I will point out, although an option is a choice, I did mention it. However, that changes when you're selling options because you are selling rights, you are selling the obligations, which means if the options owner decides they want to exercise their rights, you would be obligated to meet that exercise and deliver or purchase the underlying asset. All right, so we know the macro piece of options. Let's look at an options order. So you can see one on the screen. It reads sell one ABC November 115 call, 1550. That's a mouthful, right? So let's break it down. Let's look at each component. First, we have side. So what is the side you're taking on this options order? Are you a buyer of options or seller? In this example, we're a seller. Quantity. So how many options contracts are you looking to trade? This case is going to be one. We've got the underlying. So what underlying is the options contract based on or derived from? In this case, we're going to say it is an equity option. So the underlying is stock ABC. Followed by expiry date. So this is the day on which the option stops existing. It expires. In our case, it's November. Followed by the strike. So this is the set price at which you'd be buying or selling the underlying asset at the option's expiry, depending on your side and option type. Which brings us to option type. So there are two types of options. You've got calls and you've got puts. In this case, this is a call option. And finally, price or premium. This is a very important one. This is how much you would be paying per unit of the underlying controlled by the options contract. So in this case, it's going to be 1550. So when I put all of this together, we get sell one ABC November 115 call at 1550. So now that was an example of a call. Let's look at what a put option order looks like. So we have it there. So it reads as pay 1060 for 3 ABC November 120 puts. Now you might notice the language switched up a bit, right? And that's by design. Reason? Pretty simple. Efficient communication. So when you are a trader on the trading floor or in the trading pit and you want to get your order across and you want the other traders to get it right, this language tweak makes it possible to communicate what do you want to do, how do you want to do it, and what are the details in a very simple format. Hence the switch. All right, so next we're going to talk about that embedded leverage component that I had mentioned at the beginning of this session. So options do have embedded leverage. And to see that in action, there are two key components you need to know about. So you've got quantity, which we just saw on the previous slide. It's the number of options contracts, calls or puts that you're looking to trade. And you've got contract multiplier or contract size. That is the amount of underlying asset that's controlled by one derivatives contract. So for example, for most equity options, this is a standard 100 shares. So each equity option mostly controls 100 shares of the underlying stock. Now to the leverage part. So let's think about the previous example that we went through with the put option order, right? We were looking to trade 3 puts and we were looking to pay 1060 per unit of the underlying. So in reality, if you went onto your broker's app and you decided to place a trade, you would be trading 3 puts. But how much would you really pay for it? It's not going to be 1060, right? So that calculation is something called total premium. And that's going to be quantity times multiplier times the premium or price. So essentially for our previous example, it's going to be 3 times 100 times 1060. So if you were to place that order through a brokerage app, you would be paying £3,180 to trade that options order. But, and this is where the leverage component comes into place, your exposure is not just worth a little over £3,000. It's actually going to be measured by something called notional value. And in the world of options, notional value is calculated as quantity times multiplier times the strike price. But essentially what it's saying is if you were to go into the stock market and trade this amount of stock, so 300 shares of stock, how much would you really pay? Well, you would pay 3 times 100, so 300, times 120, because that is your strike. So you would be paying 36,000 pounds. And that is the leverage we're talking about. By paying a little over 3,100 pounds, you have gotten exposure worth 36,000 pounds. All right, so everything we discussed up to this point is you know about options, you're looking to place an order, maybe you place an order. What happens after you've placed an order and as your option nears expiration? What happens at expiration? Well, let's find out. So as your option gets closer to expiration, the concept of exercise comes into place. And as the name suggests, it's basically you as the option owner deciding if you want to exercise your option and either take delivery of the underlying stock or sell your underlying stock to someone else. Now, there are two exercise styles. You've got American-styled options and European-styled options. I will say this has nothing to do with geography. It is purely part of the nomenclature. Both American and European-styled options trade both in the US and Europe. But there is a difference between the two. So American-styled options can be exercised on or before the expiry date. European-styled options can only be exercised on expiry dates. Now, the other concept is called settlement. So how does your option settle after it's expired? Well, there are two ways. So first you have physical settlement, and once again, as the name suggests, you would be liable to either deliver the physical underlying shares, if it's an equity option, to the option owner or purchase them depending on your option side and option type. And so it can get a little bit tedious. The other side though is cash settlement. So as the name suggests, once again, you are not exchanging any underlying. It's just a pure exchange of cash, which is usually the difference between the strike price and the underlying price. And that cash payment occurs and your option is settled. Now, one other concept that I do want to point out, and we are going to touch later with our examples, is called moneyness. So when you think about exercise, how do you know it's the right time to exercise your option? Well, that's where moneyness comes in. So there are three types of moneyness when it comes to options. You've got at the money options, out of the money options, and in the money options. And we're going to learn what each of them indicates in. Another thing to keep in mind, most single stock options are American-styled options, and they are physically settled. So you'd be liable to deliver the underlying shares or purchase them. But most index options are European-styled only, and they are cash settled. So no hassle of actually delivering or receiving the underlying shares into your portfolio account. All right, and on to some examples. So let's see how options really play out in the real world. So we'll take the index option as an example. We're buying an index call option, and the underlying index is going to be the Cboe UK 100. So that's the top 100 companies in the UK by market cap. And we'll say that that index is trading at a price of roughly 867 pounds. Now, we are buying an 870 call option, and we'll be paying a premium of 17 pounds and 55 pence for it. So, how do you look at your profit and loss in the world of options? Well, we're going to build it together. So first, we'll mark our premium on the y-axis, right below that x-axis. It's a negative amount because you are the option owner, so you're paying that premium to someone else. After that, look at the strike price. So the strike price is 870, we'll mark that on the x-axis. There it is. And these two give us enough information to calculate break-even. So you've paid $17.55, but when does this option essentially start making you money? When do you get the positive P&L impact on your portfolio? Well, since this is a call option and you're the buyer, remember you have long exposure. So you're hoping the underlying price goes up over time. So to calculate your break even, you'd simply add the strike and the premium. So 870 plus 17.55, you get 887.55 pounds. That becomes your break even. So once this index crosses that 887.55, that's when your portfolio impact is net positive. So now, we connect the dots. We draw a flat line from that premium point up until the strike price, because up until that point, your option has no intrinsic value. It's not making you any money. So your max loss is going to be 17.55, and that will stay true until the index crosses 870. Once it does though, your option starts building some value into it. It has some intrinsic value for every pound the index moves beyond 870. And that will keep happening until it crosses that break-even point, after which you have recouped the premium you paid to buy the option, and now you're starting to make money. And just for some clarity, so if you look at that, so everything up until the break-even point is some sort of a loss, but once your underlying crosses that strike price, the loss starts to get even lower. And then anything beyond that break-even point, that's your profit, that's your gain. And for a long call option, that profit is defined as infinite, because in theory, a stock can go to infinity. Now this is where moneyness comes into play. So exercise and moneyness. So as anything that is in and around that strike price is considered to be at the money. So your option is set to be at the money option. So its intrinsic value is roughly around 0. So it's right around that point. Anything before that is considered to be out of the money option. So your option does not have value, it is out of the money. And anything after that 870 point is considered to be in the money. So your option has some intrinsic value attached to it. So it's not going to expire at 0. All right. And this is what your payout would look like if you were an option seller. So if you were selling this call option, let's say you were selling this call option to me, this is what your payout would be. You would collect that premium at the start of the trade, right? Because you're selling the option. But as the index level starts to climb, you start to lose money. And your loss starts to intensify once it crosses that at the money point at 870. All right, so that was the call. Let's think about the put option. So I say you're buying a put option. Once again, you are the buyer, strike is 870, and your premium is £51.15. So we'll once again mark our premium on the y-axis and our strike price on the x-axis, or at the money point once again. The next thing is calculating break-even. And now break-even's a little different because you are long a put. You are a buyer of the put option. So technically you have short exposure. You're rooting for the index level to go down. You're betting that it'll go down. So your break-even has to be lower than 870, unlike the call option. So basically you would subtract the premium from the strike price. So if I do that, you get £818.85. So once the index crosses that point, that's when your put option is truly net positive. Now, you connect the dots again. So as you can see, the line is pretty much flat up until at the money point, which is 870. And once the index passes on lower, your option starts to make money. But once again, it's only once it crosses that break-even point that your option is net positive. So your portfolio is in the green, basically. And for put options, moneyness is defined slightly differently. So at the money stays the same. It's in and around your strike price. Anything above the at the money point is out of the money for put options. And anything below that 870 is considered in the money for put options. All right, so as a quick review, we went through the features and characteristics of options. We try to look at the reasons why investors use them. And then we explored payout diagrams. They are a very great tool to measure your profit and loss scenarios in various option strategies and really understand like how much can you really make or lose on an options trade. So once again, thank you so much for listening. We do have a couple of QR codes on the screen. And if you have any questions about anything I went through today or how you can continue learning, please do come find us. We're at booth 26, 26, 27. We'd be more than happy to chat. Thank you for listening.